Good afternoon, everyone. It's 3:30 p.m. on Central Time on Thursday, the 30th of June, 2016. This is an AMA session open to the public. Let's start off with the disclaimer. Derivatives trading involves substantial risk of loss. It is not suitable for all investors. Past performance is not indicative of future results. Everything I'm sharing here is my opinion, and it's important for you to understand and to check it for yourself before applying it to a live account. The rules for these sessions: priority is given to participants who have submitted their AMA question. We have 25 questions. The form had disengaged or turned itself off at 25 questions to max out. We also want to take mic questions, but if we don't get through the submitted questions, then we won't take mic questions. There's just a lot to cover. One question per participant, and the webinar is recorded and will be sent to you. This is why it's important to at least register for the webinar, even if you cannot attend it. That way you get notification. And of course, if you want to contact me, geez, that goes by real quick. If you want to contact me, futurestrader71.com/contact. It's not always I who responds, but hopefully we'll get to your email and get you your answer, okay? So let's shut that off. Let's take it to the questions here. And let's have Richard come on here. Richard is going to help me stay organized. He does a great job of making sure I stay on track. So I've split up the questions into categories, and you'll notice there's an italicized portion here. These italicized questions, if your name is on here, these are questions from stage 5 traders, and the reason we put them at the bottom, that we don't value our stage 5 traders, but we have weekly AMAs, and I want to prioritize those who aren't or can't be at stage 5 trading, and we can get to your question next week. So first, we're going to just get to the newcomers and those who haven't asked questions before. The categories are education, money management, psychology, risk management, and a lot of technique-based questions, as well as trade management. The first question is from Michael. Michael says, we know the downside of futures trading. Most fail in short order and don't succeed. Could you go over some success parameters that you've seen very good traders obtain when they are successful? Sometimes hearing positive stories can help some of us when tough times arrive. First, I take issue with the fact that you believe, or you're stating, that most fail in trading futures. That's something that's been thrown around. 80% of traders will fail, 90% of traders will fail, and we've discussed this in the past, but again, I want to state that anybody who takes on anything without some sort of structure is more likely than not to fail, and trading is no different. So jumping into an airplane, a commercial airliner, and reading a few manuals and doing a Microsoft Flight Simulator simulations on my computer at home, and then jumping into the cockpit and then starting to fly an airplane, I'm probably going to cause some serious harm. And trading is no different, okay? But under the right structure, under some structure, any structure, under committed conditions, under a growth mindset, and someone who is sticking with and is mastering one or a clear approach to the market, my personal experience has been that the potential for success is very high. In my own prop shop, the ratio for success was in the mid 90%. My expectation is that a person will finish their 3-year prop contract and move on to trade independently. That's my expectation. That's what I saw. However, when you talk to brokers or brokerages and you look at the industry, most will tell you that most will most traders will fail. And the reason they'll fail is because people come into trading thinking it's some sort of a slot machine or a way of just clicking, clicking and making money. And so the information coming in is very misleading. It's a great question. Now, as far as what parameters do successful traders have, I can only talk about my own experience and the experience of those that I've backed and have been around. But in the days when I was scalping equities, when I started trading NASDAQ equities, it took most folks in the incubator that we were in this environment, took most folks 6 to 8 months to be to have taken their drawdown and are on their way back. In other words, getting a positive expectancy on a regular basis. Generally, in about a year, folks have already paid back their drawdown and are starting to be able to withdraw money from their account. And in futures specifically, because that's the area, I didn't back anyone in prop in equities. I backed people in prop in futures. And in general, on a $25,000 account, the expected return is 60% per month on equity, not on notional value, but on equity. And it is highly leveraged. And as you know, leverage introduces a significant amount of risk. It's not suitable for everybody. But in general, that's what I was looking for. So on $25,000, I was looking for somewhere around $15,000 or so in gross returns per month, and a net split with the trader on most months, and then a lot of times it was 80% or higher. Why? Because we were trading a very, very high notional value. In other words, some of the positions were in the millions of dollars for several minutes in a day. But the most important part that I would like you to take away with this question as I move on here is that the focus for those people who are serious is not on how many dollars they're extracting on a monthly basis or on a weekly basis or on a daily basis, although that's how we like to measure our performance. The most important factor is the mindset and the process, instilling yourself in the process. And I can go on talking about that for an hour with many, many examples of how things go crazy when you go off of that mindset, away from your mindset.
But I'm going to tell you 5 minutes.
5 minutes. Wow, that was 5 minutes. Holy cow! And to get more information, to get more information on mindset, just go to my website and look up this webinar I did about mindset. To get an idea of what I'm talking about there. So that's an important question. Let's get rid of that. Next education-based question by Stephen. Can you give me a short list of things to learn and or books to read in order to build a solid foundation for learning trading? And for that, I'm going to point you to this website to make up for the last 5 minutes. I'm going to point you to futurestrader71.com/resources, and in here you'll have a blog with many posts, books, movies to watch, recommended equipment. There's a video archive in there. Just go see that. That's a good place to start. It's kind of a condensed way to start on what I felt was important to read. Did I make up for your 5 minutes there? Education. Again, 2 questions. How is the price on the futures determined? Is there a specialist, or is it electronically driven, such as HFT, etc., or a combination of several inputs? The price in futures is driven by demand and supply, because futures are almost a pure price discovery process. There is nobody that controls the number of contracts that can be floated in the market or can be pulled out of the market. In other words, the CME, the exchange, cannot buy back contracts to raise the price of the S&P 500 or cattle or crude oil or whatever. The CME acts as a meeting point for buyers and sellers, and there's an infinite number of futures contracts that can be traded, but there's a limited number of contracts that can be held by any one participant. Okay, so that's why when I moved to futures, I never look back at equities. There's a lot that can be done in equities to control or manipulate a stock. Very little that can be done to manipulate the futures. I'll move on here. I'll leave this up, but I'll move on because it's one question per participant, okay? Money management. What will be your advice regarding the initial balance required to begin trading ES, futures ES, and the advised number of contracts to trade in relation to this initial balance requirement? I'll make this very simple, Camilla. For the ES or any other product, just trade the initial margin. So if you go to our website or the CME, preferably the CME because it's the authority on it. But if you go to the CME, go under trading, go to whatever category, equity index, in this case you want the S&P, you can look at the S&P futures and go to margins. And it'll show you right here what the maintenance margin is and the initial margin. You can get the initial margin in various places. The clearing firm I trade through is Gain. And the initial margin is 46.20. Okay, that's how much I would recommend you would have per contract as a minimum to trade. I know you can trade with $500 margins in some places, even $400 or $300, which I think is absolutely insane. But my recommendation is per contract, you have your balance on your account is at least the full initial margin per contract you want to trade. In other words, 2 contracts, you need about 10,000, 3 contracts, 15,000, and so forth. And that helps temper the leverage and the amount of drawdown you're going to get on one contract and help stabilize the overall volatility of your equity curve, in my opinion. So that's it. Just keep it simple. Take the product you're going to trade, figure out the initial margin in the futures, and just trade. Just make sure you have the full margin per contract you want to trade. It's a good place to start. There's a reason the exchange uses that value for margin.
Just before we go to the next question, on your last question, you said that futures can't be manipulated. But are futures not based on equities?
Yes, they are, but they're based on a group of equities. So if Hershey gets halted because it's being bought by Mondelez or whatever, if they happen to be on the S&P 500, the effect is not that all of a sudden your shares are worth 30% more or 50% less. The impact on the futures is not going to be as detrimental as it is if you're trading an individual equity.
Okay.
That's really the difference. It's a universe of 500 stocks. One CFO is not going to have that big of an impact on the that universe. It's too big.
Yep, that's good. Thank you.
Psychology. Chris, what is the biggest win you've ever had and how did you trade after it? I recently had my biggest profit and feel invincible, even though that's a recipe for disaster in trading. This has a lot to do with webinar 3 on my website. I'd suggest you take a look at it. This is the risk-averse, risk-seeking personality within all of us. When we are losing, we become either risk-averse or risk-seeking, depending on our personality type. We either fight or we back off. When we win, there are people who believe that winning only leads to losing at some point, so they become very risk-averse, and then they start to tighten up too much and losing their edge, losing their flow with the market. Your goal as a trader is to balance, to be somewhere in between. If you're winning and you feel invincible like you're saying here, if you were a trader of mine, I would be cutting your risk in half. I would be slowing you down. I would be forcing you to wait out the first hour of trading the next day, things like that. The reason you are feeling invincible, and even though you know it's a recipe for disaster, you're still taking the amount of money that you've made, and you're still looking at it as house money. You're not recognizing the fact that the reason you made that money is because you were in alignment with the market. You traded the market as it is. So it's really important for you to just get back to and this is hard, by the way, to just focus on the process. Focus on the process, not the fact that you had a huge day yesterday. My biggest win was a lot. And the way I traded after it is to come in and cut my size and build credit for the day. And then the next day I made a lot again. And this was 20, well, my biggest days were 2008, fall of 2008. The crash were my biggest days in futures. And then post 9/11 were my biggest days in equities. Just the volatility, I thrive on volatility because I can scalp the market pretty well. Let's move on. Dan, another psych question. Do you believe anyone can become a successful trader? When should someone give up on trying to become a successful trader? This is a huge topic. I'm a proponent for accepting your failures, right? But do I believe anyone can become a successful trader? Yes, I do. And here's the reason. Because we are all born the same. We are born with the same number of brain cells. We're born with the same ability to teach ourselves. Some are slower than others. Some have disabilities and so on. So anyone and everyone is a very blanket statement. But I believe that with the right mindset, you can become anything. And so, again, watch the webinar that I referred here. This is a lot to do with trading mindset. Watch this webinar on trading mindsets. But the question of whether or not you should give up is, here's how I approached it, because I was on the brink of giving up when I learned equities, and again when I learned futures, because I was just running out of money before I forced myself to make the turn. If you are doing everything right, in other words, you're doing everything you know you have to do, in other words, you're putting in 110%, and you're still not getting it, then you are not destined to do this for a living. However, almost everyone I know is looking to give up out of emotion, out of frustration. It's generally an emotional response that causes people to give up, not because they're doing what they're supposed to do. So it's a lot like failing on a diet. They know they're not supposed to have that box of cookies, but they have one cookie and then all of a sudden a box is gone and then a cake and a whole dozen donuts after that. And then they sit there and go, diets don't work. No, you're not able to maintain. Your tolerance for discipline is not high enough to maintain what you need to do. If you're doing 110% of everything you need to do, and I've covered it many times, just you can follow actually there's a webinar called the No Nonsense Approach to Trading on a Big Mike, and it's also on my YouTube channel. If you're doing all those things and you're still not seeing the upside, then you're destined to, your time is better spent elsewhere. And that's the biggest cost in this endeavor and any other competitive or performance-based endeavor, is that your time, not your money, is unrecoverable. But I'd be willing to bet that you're not doing everything you know you should do. And so you get beat up on a day and you just say, I give up. Okay, I can pinpoint for any person who's about to give up, I can pinpoint 2 or 3 things that they've been told and know they should be doing, and they're just not willing to do them. And so maybe you should move on because you don't have the discipline to perform at the level you need to. But are you able to be a successful trader? Do you need to be born to be a successful trader? I think anybody can be a successful trader, and you can't. I believe the belief that somebody's born talented to trade is absolute and utter nonsense. There's no such thing. Another psych question, last in the category. I'm a discretionary price action trader. I trade stock futures and NSE. I trade different stocks every day. I watch Trader Bites every day to learn. It is said that any edge in the market is fleeting. Is it really true? I'm profitable more than 80% of the days. It took me about 3 years to become profitable. If that is the case, then how can traders be consistently profitable? Or is it a lie to scare people away? As you said in the last webinar, Trading Mindset Part 2, greatest challenge for me to become profitable is changing my mind. Is this the biggest edge we need to have as traders? I really feel blessed and lucky to be learning from you. Noble, thanks for writing in and the compliment. It's said that any edge in the market is fleeting. It is true, and here's why. Because the market is consistently moving. It's consistently changing. So a fixed edge, in other words, if you're trading a system with very clear parameters, an automated strategy, for example, that you're not adjusting with volatility, with range, with whatever, news events or what have you, then that edge is likely to erode over time somewhat, even on a robust system. So you constantly have to make sure the system stays adjusted. But you're trading as a discretionary person. If your attention is really on the market, then you are consistently changing your approach. You're consistently observing changes in the market and hopefully are correcting or changing or adjusting your approach. This is why you can be consistently profitable. It's your statement that the edge is fleeting and therefore, there's no way to make money perpetually in the market. It's true if you have a very rigid system, a moving average based system or something like that. But if you're a discretionary trader, in general, you're constantly changing. I mean, if you look at the way I trade today versus the way I traded 2 years ago, there are definitely adjustments, and the year before that, definitely there were adjustments. Trading through 2008, 2009, massive adjustments, cut size dramatically, increase stop ranges dramatically, let runners run a lot more. So you're reinventing yourself every day. Why? Because you have a growth mindset. You're constantly changing and redefining yourself as a trader, and that is a huge edge. But your process, your approach still has to make sense overall, and that edge has to exist for you to continue to be profitable.
And on that, if I can just clarify, you were changing not your system. You still did volume profile. It was just parts of what you were doing. You weren't looking for a new, saying, this didn't work, I'm going to go find something else to do and keep jumping around.
That's correct. I don't jump. It's really important to make, in order to make money at anything, be it trading or selling insurance, it doesn't matter. You need to be a master at an approach. So when I say changing, I'm not talking about one day using this approach, then volume profiling, and then tomorrow I'm going to use a MACD RSI based system, and I'm not talking about that. I'm talking about how I'm adjusting the same approach, how I'm adjusting to the conditions. I'm not changing the way I'm viewing the market or the theory or the process behind my trading at all. So that's a great clarification. Next category, risk management. Thanks for that question. AC. Asking, according to what I have read online, it states that a system trading performance should have a profit factor of 2 or more in order for it to be worth the risk. Profit factor being the ratio of wins divided by losses. In other words, for every 2 units of revenue, of profit, there's a unit of risk. Do you think that that is achievable for a day trader? If not, what is more common for a professional day trader? First of all, context, time frame. Yes, there are ways to trade and get a profit factor of 2 to 1. In fact, a lot of overnight based systems or approaches that trade through the Globex session and hold overnight, it can generate 2 to 1 risk reward because of the extent of the range that occurs overnight. But as a day trader, and especially if you're systematic in your approach, like a strategy or something, it's really tough to get 2 to 1. In fact, a lot of times you get 2 to 1, but the percent win drops dramatically. So you have a 2 to 1 ratio, but you find that your win percentage is 40% or 35% or something, and you're basically behaving almost like a trend following system or a momentum-based system. Day trading, you're really looking, in my opinion and in my experience, I'm looking for about a 1-to-1 ratio with a large sample size. That's all I'm going for. I'm not trying to catch that trade that's going to, get me 10 times my risk or, 5 times my risk. I'm not really interested in that. I'm looking for chunks because my imperative is to keep losses to a small amount and to keep managing risk. I don't have the psychology or the patience to take 6 losses in a row so that I can catch that one trending trade and hold it for 6 days. And that's going to get me the 5-10 to 1 risk return. That's on a day trading basis, that's very, very difficult to do, especially in a non-directional product. In the futures, generally, most equities and futures are generally non-directional, and that's, it's going to be very, very hard to get that. Now, if you trade a commodity like ags or something like that, where there's a drought and then the market's trending, yes, but you're essentially becoming a trend follower in order to get that high a profit factor on an intraday basis. Again, the time frame is intraday. I don't want to get emails telling me, well, my system does better than that, blah, blah, blah. It's hard to do, I think. And I'm just not an expert on that topic. Technique, this is the biggest category here today. The first question is from Ota. Thank you for everything you're doing. I would like to ask you about statistics on a rotational behavior. In other AMA, you said that you're waiting for an impulsive move and then you take a trade, which entry should be in the first 50% of the impulsive move. That's not quite what I said. How do you define parameters for the study? Can you suggest other practical statistics for rotations? I want to trade just when my trade idea hypothesis is supported by statistical edge, but I wasn't really successful in finding one. So the issue you're talking about is your goal is to find a statistical edge, but you're not finding one, and you're looking at the rotational study or an impulsive, the impulsive approach, impulsive pullback continuation approach to do that. First, understand how these impulsive moves take place, but just to answer your question, today's not a good example, neither is yesterday. But in general, in a normal market, so we're going to scroll back in time. In general, we're looking for, in fact, I had a trade today that was based on that. So an impulsive move, so if we look at a quick study that says, a quick study that's looking at, that's studying what rotations are. This one here is for the Euro stocks. Let's switch to ES. I'm going to take maybe more than 5 minutes on this one, but let's switch to ES on a 1-minute basis. And what this chart here does is it computes the what the rotations are for the ES historically, going back 30 sessions in this case. And what this is saying here is lately on a 1-minute chart with, well, zigzags 1, I don't know why that is. This doesn't seem right. But it's saying that the first standard deviation of rotations upwards is 2. It's actually more like 3, 3.5 right now, with the second standard deviation being at about 5. So let's forget about this chart for a minute. It's not computing right for some reason. So anything above 90%, which is about 4.5 points. So in the ES, a move, one rotation, one zigzag rotation, and the zigzag is based on, why is this? And a zigzag is based on 6-tick pullback. If you have more than 4.5 points, I consider that, I look for what the market has done, how that rotation was created, and that's why you get all these numbers here. These boxed numbers are all rotations. And then I look for an idea that supports an impulsive move. So we don't have anything clean here because the market's really been grinding up. But in general, if the market's sitting sideways and then it suddenly explodes upwards, so let's look at this move right here that happened the other day. So this is an 8.25 point move without a pullback, but really what this is, and you can see the pullback was not really that significant. This move happened from 2009 to 2024. That's a 15-point move. That is a 6 standard deviation move in the S&P. In other words, the probability of the S&P making a move like this is less than, you know, 1/10 or less than 1/10 of 1% of all rotations have this sort of move. And so what this is saying to me, with the volume that's coming, what this is saying to me is that a higher time frame has stepped in and is pushing the market. And in general, when that happens, we get a pullback that's around 50% in nature. So let's take this impulsive move took place to 24.75. Let's take it up there. And so as long as it stays, if I have something around the 50%, and in this case, and actually I announced this in the chat room, in this case, 20.18 represents the IB. It represents a low volume node, and it's above 50%. This becomes an area of interest for a long, and I'm looking for a break of 25.75. Market pulls back to that, to this low volume node, and then I'm looking for a continuation higher. This would be the type of setup I'm looking for. Now this is an exaggerated setup because we don't see a 15-point move very often. Generally they're like 6, 5.5, 6 or so. But as soon as I see something that is 5.5 or 6, I'm looking for a pullback that is less than 50% or less against an area of interest. Then I'm looking to go in the direction of the impulse, and I'm targeting that high, that last high that was achieved. I know that's a lot to process maybe. You might want to listen to this segment. Again, I don't have that much time to cover the details of it, but that's just what I was talking about. It's not that I go out and look for every impulsive move that happens in the market, every larger than normal move, let's say, and then I'm buying the 50% pullback. Because if the impulsive move happens into a large confluence of resistance against a big volume node, then I'm not going to be a buyer on the pullbacks. When we look at Bookmap here, here's a large offer, 2090, and the market explodes upwards on the end of month on the close. I am not buying the pullback here. This isn't going to happen. I'm not going to be getting long this particular rotation that happened on the close today because it's colliding with some major resistance with liquidity overhead. The probability of it pulling back and retesting that is pretty low, in my opinion.
And so, just before we leave that question, the rotations also depend on the time in your chart. You were looking at a 2-tick Renko. So the numbers that you gave related to a 2-tick Renko in the ES.
Correct. Yeah, the rotation changes if you go to a 5-minute chart. The rotations completely change because a 5-minute chart cannot use a 6-tick pullback. It has to use a higher number. And what is that higher number? I use the fractal chart that I pulled up to figure out what that higher number is. I used to do it manually in Excel, but IRT makes it much, much easier to figure out what that number should be. And please don't ask me what the number should be. I get a lot of emails asking me what it is for crude oil in a 15-minute time. It's just I don't have the time to run it. Just get IRT, get that study, and off to work you go. Another technique question from Carlos: how do you use the opening swing as a tool for trading decisions? So I get that question a lot. The opening swing is simply a measuring stick for what we should expect. The opening swing, for those who don't know what it is the is this blue line right here. The opening swing, high and low, are essentially marking off the first time sellers step in, the first time buyers step in. So the market opens, then the market pushes in a direction and it runs into sellers and it turns. We want to mark that first spot because the market on open orders have executed and they have been met with the opposing force. Then the opening swing low is when the market drops on the open and then is met with buyers and it turns. And it's much, much cleaner when it crosses the opening price. The opening price is this dotted green line. Then we can see the opening swing very clearly, and you can see that today the opening swing was 69 to 64 and a quarter, which is actually larger than normal. The opening swing takes, it gives us an idea of how the market is treating that first set of orders that cleared the market. And generally the first set of orders are based on daily charts, are generally a higher time frame play if present. Otherwise, if the opening swing is very small and it's doing this, and the opening swing is, a couple of points, then it gives me an idea that, hey, short time frame traders are in control, which means day traders are in control, which means that it's likely to consolidate, and then I'm looking for a strong break out of this zone. There's a stat that I use with the opening swing. In general, when the market moves away from the opening swing and pulls back to it and breaks in after the first hour, in general, it has a high probability of testing the other side. So once it breaches into the opening swing, we generally see it go and cross to the other side, and it creates, the opening swing creates, if I'm short, it creates an area for me to scale out ahead of the opening swing high. Once it pushes back in, I try to add, and I'm looking to scale out ahead of the opening swing low because it's very likely to breach it on most days, or general mean reversion day. So that's what the opening swing is for, okay? I've already defined what that opening swing is. Just replay the video and you'll get that. What info do you glean from the opening swing? So that's the same. And do you have templates for Sierra charts? I do not. I know there are many, many traders, and I know in the chat, in the S5 chat room there are, so I'm sure there are on the internet, on Twitter. Maybe send a message out to the FT71 hashtag asking, but I don't use Sierra charts. Grant, my friend John taught me to buy when the relative strength index RSI falls below 30 and to sell when the RSI increases above 70. Often this technique has left a lot on the table. I was wondering about selling when it increases above 75 or 80. What do you think and why? Grant, I'm going to, I want to challenge you on this question, in that you're trading an indicator that gets pegged. I don't know what your periodicity is for the RSI, what your parameters are, but I'm going to throw an RSI here. And what happens is your let's thicken this up here a little bit. Let's make it nice and yellow for everybody to see. Let's thicken it up 3 pixels. So what happens with this RSI is, here it is at 70 and 30. Are you selling right here because it's above 70? Well, if you sold it, then you got crushed as it went to 68.50. Are you selling it right here? See, the problem with these sorts of indicators, especially if I increase the periodicity here to something larger like 14 or 20, 21 and 7, The problem is as the market keeps pushing higher, the indicator, if you do it on a spreadsheet or do it by hand, you'll find that mathematically the indicator will continue to be overbought as the market rallies and rallies and rallies, and it just continues to struggle to get out of its zone. And that's why trading off of an indicator without understanding what the market auction is, what the market is actually doing, is a dangerous thing. Now, there is merit to using an indicator to decide when to hop in if you understand what is going on. In other words, if you're basing your decisions on price action or the auction, preferably the auction, and you decide that you could see from the auction that we're pushing up against some major volume up high, up top, and it's resisting, and the market starts turning over and your RSI starts dropping very quickly, that may be an indication for you to get in with a wide stop, wide being 3.5 points or larger, for example, and looking for that resistance point that's based on the auction itself. You're playing the resistance point, not the RSI, but you're using the RSI for an entry. I can, there's no dispute there. I can understand why you're doing it. But trading off of an indicator alone is very misleading in that it's not telling you the full story. And on days when the market pushes directionally one way or another, you'll find that your indicators become very misleading. They're overbought and overbought, yet the market keeps going, and the indicator is up against 84%, it goes to 85%, but the market has moved up 20 points from when it was at 84%. And it's telling you that everything is overbought, but the market just keeps ripping higher and higher and higher. But using an indicator to enter the market as a timing thing based on structure, based on the auction, I think you have a much better edge than just looking at an indicator as if it's a full trading system by itself. So I would ask John how 75 or 80 would work for you, because I don't use it, but I would caution you on using just an indicator to trade the market. I know people make money with it, but you'll find that generally they're really good at reading the product and just use the indicator as a way to get in. Mark, how do you recognize the different day open types quickly and react to it? Open drive, open test drive, open rejection, reverse, and so on. So I announce those on Twitter every morning, pretty much. I'm finding by the time I see what the opening type is, it's too late. Any tips and advice on anticipating the opening type in order to adjust trade style around it? So here's the thing. You might recognize early on that this is an open auction out of range, okay? But that's not information enough to decide what to do. What you're doing when you're identifying the opening type is initially, it's just there to figure out what your trading approach is going to be. So if you have an open auction, it's basically saying that both sides are active. The buyers and sellers are active. There's really nothing directional going on. But if you hear open auction, in the back of your mind, you should also know that an open auction means it's likely to balance, it's likely to be choppy, it's likely to consolidate, which then leads to imbalance. Once it breaks, it's likely to gain momentum, because the more people trade in a range, the more likely the break will be strong. But you can't decide, oh, it's an open rejection reverse, get in long right here. In and of itself, identifying the day type early on isn't something you trade off of. What it does is it tells you which plan you need to trade. Am I trading the buy the pullback plan, or am I trading the sell the extremes plan? In other words, am I trading from the inside out, meaning I'm trying to catch trends back into the range to trade out of the range, or am I looking for the market to extend itself in a direction to sell it or buy it back into the range? And that's what the opening type helps us do, is it just helps us structure the day and tells us, look, with an open auction, don't trade breakouts. Don't take breakout trades. Yesterday was a big trend day. Today turned out to be a big trend day. But with an open auction today, my primary hypothesis that the market's likely to get choppy and drop has a pretty good chance. So I'm going to look to trade. I'm going to look to wait for it. I'm looking for balance, and I'm looking for some sort of resistance to sell against. And if that fails, then I'm going to buy any push out of this opening range. I'm going to look to buy that push back into the range if the market ends up being balanced. But it's not something you decide within the first couple of minutes and say, okay, I'm going to put a trade on just because of the opening type. The opening type just tells you, is there a directional participant in here? Is there a fund in here that's pushing this market? Is there the higher time frame in here, the OTF, or is it a bunch of day traders pouncing on each other and creating an open auction back and forth, back and forth? That's what it's good for. And by the way, knowing that is a huge edge. Bill asks, explain when and how you use BSO. So BSO stands for best scale out, and it's a metric in the trade analyzer. And the trade analyzer is a tool that I created back in my prop shop to help traders monitor their performance and for me to monitor their performance as well. BSO just tells us from the average price, entry price, how far did the market move for your best scale out? In other words, how far did the market move in your favor and you locked in a profit? And BSO is really important. It doesn't take into account the fact that you're trading 10 lots or 100 lots or 1 lot. It's just considering per contract, what is the best distance that the market has moved in your favor and you were able to capture that profit. Now, if all of your trades have a BSO, in other words, if I look at your log and you're trading more than one contract, you cannot have a BSO with one contract because your BSO becomes your gain for that particular trade. You cannot have a BSO you can't scale out of one contract. But if you have 2 contracts and I see that 70% or 80% of the time you get a best scale out. You get one contract off at some price. Say 4 ticks after your entry, you're getting a BSO. And the average BSO is, say, let's for argument's sake, your average BSO is 5 ticks. Okay? And you get 5 ticks 80% of the time. Then it's telling me that you can probably squeeze more out of that scale out. You need to, your trade placement is so good that you need to improve your outcome by increasing that BSO by a tick and seeing how your percentage drops. If we increase it from 5 to 6 and your percentage drops from 80% to 75%, then I'll say, hey, squeeze another tick out of it, keep doing what you're doing, but look for another tick. And then at that point, it might drop to 50% or so. Also, once you get a scale out, it also means that you've mitigated your risk. So if you have 2 contracts and you scale out at 6 ticks, you have just bought yourself a stop to break even of 6 ticks more. So seeing a trader getting a lot of BSO, and you do not have a BSO on a losing trade in general, seeing a trader getting a lot of BSO says that their trade placement is good and there's an opportunity to squeeze more out of the trade. It's a refinement tool to see the BSO. Now, if you get in and your BSO doesn't exist because you keep getting in and demanding 4 points, 16 ticks on that first scale out, that means you're exposing all of your risk. You're holding 2 contracts and you're either going to get 16 ticks or you're going to get stopped. You're exposing too much risk without a scale out. In that situation, I'd say, cut it back. Let's bring that first scale down, to 8 ticks or something. And that way we can mitigate risk and you can just relax because you have room for the trade to kind of come back to break even, maybe go against you a little bit, and so on. But still, the trade is in the money. You've funded the trade, and you can just relax. That's what
Is there a
BSO is used for.
Sorry, is there a percentage that you say that's good for a scale out? Is that 30%, 40%?
I generally look for anything above 50% as being opportunity to get something more out of your upside. I mean, if you're
Okay.
getting a BSO on half your trades or better, then you're probably ready to squeeze more out of each trade.
And if it's, say, under 30%, then you should be looking at scaling back?
Then your scale out is two things. Your scale out's too far. It's way outside the harmonic. It's way outside what the market is able to give you, or your entries are really not very good. In other words, you're jumping in too late to get even, you put out a scale out at 4 ticks, but if your entry's so late that you're not able to get 4 ticks, it's telling me that there's some issue with the way you're entering the market. You're taking a lot of price risk, right? You're waiting for too much confirmation and are jumping on the market too late, and therefore not allowing the market to give you at least a scale out. For me, the entire trade is based on getting that scale out. That scale out is really important for my trades. It's what has kept me in business for 16 years, and it's what's going to keep me in business. If I can get the scale out, then I have mitigated my risk and I'm able to manage the trade much more easily, and I'm able to add to the trade if necessary. If I don't get a scale out, then I'm likely to get stopped on a full boat, a full unit, and it'll set me back quite a ways. So I'm always looking for that scale out, but a scale out of a tick or two is no use because you're taking on all the risk and all you're squeezing out of it is a tick or two. That's not going to be very useful. To me, a scale out for your product needs to be about half a harmonic minus a tick or two. So if you're trading crude with a harmonic of about 12 to 14 ticks, your scale out needs to be at about 6 ticks. So 7 ticks is the mid, go to 6 ticks or 5 ticks, and then that way the rest of your lots that you're holding have a little more room to work. And if you get stopped out at your original stop, the loss is not as big. You're basically creating asymmetrical risk in your favor by scaling out. Tony, let's see, how far along are we? We're 50 minutes in. Tony, do you use market internals when trading ES? How important or not are those internals? I actually don't. I used to look at Vold, I used to look at Tick, the only things that I look at are right here. The big thing I look at is really the breadth on the S&P 500. The breadth on the S&P 500 could never be above or below 500, negative 500. It just tells me how many of the 500 stocks are above or are approaching, are pushing up against the maximum potential high or low of plus or minus 500. I do have the tick on my charts and I do have an alert on the tick, but to be honest, it's almost like an academic thing that I keep up there. I don't really look at it. It doesn't really tell me anything, and I know like others, talk about the tick. And here's the catch with these internals. Most data feeds disseminate internals on a lag. In other words, they might update them on a 5-second, a lot of feeds update the internals on a 15-second basis. Also, the New York Stock Exchange tick, even though I have it, is representing a universe of 8,900 stocks, many of which, a huge number of which, are really irrelevant. Do we care if a $1 stock has upticked? I don't think so. So for a while I was using the S&P 500 tick, and I replaced it back with the New York Stock Exchange tick. But to me, it's not useful information at all. The information I need is right in the chart that I'm trading, whether it's a stock or a future or whatever. That's the information that I need. Now, looking at Delta, looking at the sectors, things like that, I find that a lot more useful than using these market internals. In my opinion, they're not worth the subscription. You often remind prices move up, down until they find sellers, buyers. Reading Stadelmeyer and Dalton, they seem to say that prices go up and down actually to shut off buyers and sellers. Is there any mismatch between your views and the other, your view and the others? Actually, it's the same thing. It's kind of perspective. The market advertises higher prices to motivate sellers to step in, but it also motivates buyers to stop. As prices get high, those buyers become sellers, right? So it's the same thing. Shutting off buyers versus advertising prices to motivate sellers, it's the same thing. It really isn't all that different. Buyers get demotivated when sellers step in, and buyers get demotivated when prices move up, so they do get shut off. They also get shut off when sellers step in. Buyers often turn into sellers when the market turns, and sellers turn into buyers as they cover their positions. So it's really saying the same thing. You can look at it either way. It doesn't matter. The fact is the market moves up to motivate the other side to come in, either by shutting off the buyers or motivating sellers to step in. It's the same process. There's not going to be a vacuum. There's not going to be a point in the market where the buyers are bid down here and the sellers are offered 16 ticks higher and there's nothing in between. That's not going to happen. So it doesn't really matter how you look at it. Well, I've noticed that the YM rarely, if ever, gets used as an example when you illustrate market movement and trade philosophy. Is that because the YM is not representative of price action seen in other indices? I tend to use the YM for my first live trades for a week, sometimes longer, after integrating new changes into my intraday trading. I'm now integrating Bookmap's order flow into my daily trading. There's only so much sim trading that one can do, and I need to take some live trades to really get the feel of things. Am I wasting my time, or worse yet, deluding myself that trading one contract lots on the YM will really give me the realistic live trade feel I need before moving back to the NQ and CL? To answer your specific question at the end, I would say trading anything live is better than trading sim, but only when you're ready. So whether you go to the YM or a micro product or whatever, go directly to the NQ, it's the same thing. The NQ is a $5 tick for the same cost. It costs almost a tick to trade either product. So what difference does it make? Crude is a different animal. So I would stay away from crude unless you are really good with managing your risk and really good at understanding the product. The reason I don't refer to the Dow, and actually the Dow is the product that I traded first when I moved to futures. It was the product that was my introduction to futures, because I could trade it for about 90 cents and can make mistakes and still be okay. The problem with the Dow is this: it is a price-weighted index. It is a price-weighted index instead of a market capitalization-weighted index. In other words, a stock that's trading for $1,000 in the Dow, even if it has a market cap of $100,000, is going to be weighted much, much more than a stock that's trading for $2 but is worth $16 billion. So it's skewed in that way. The other problem with the Dow is that it is easy to replicate. It's really, really easy to recreate. And so it's highly algorithmic. It's highly manipulatable. It's tougher to do so in the NQ. It's definitely tougher to do so in the crude and the S&P. But it's a real product. I mean, one of my prop traders, made 300 grand a year trading the Dow without, we made it seem very easy. But I would say that as you're learning, especially with order flow, you'll find that the Dow doesn't give you enough volume to really see what's happening in the order flow. The S&P is much better. The NQ requires some adjustments, but the NQ is a little bit more liquid. Crude oil is a different animal. So don't practice on the Dow and Sim and go trade crude oil. That's going to be a very, very different universe. Joe, how do you determine the length of study on your volume profile? What intervals do you typically study? Joe, I don't know if you're here, but I don't understand your question. I don't know what you mean by the length of study on your volume profile. Do you mean how far back we go with a volume profile? If so, it's equivalent to a question down here. Somebody asked a question, I guess, about how I determined how far back a volume profile goes. If that's the question, then I'll tell you that I'm basically looking at determining when I create a new profile. So for example, we have moved into the gap zone today, and we have moved to where we were before the Brexit drop. So what that forces me to do is to now take this composite profile and this composite profile, get rid of them, and incorporate all of these profiles from way back here into a new composite. Every time the market trades back on itself, I create a new composite. So for example, when these 2 days were trading, I did not create a new composite. Let me mark it. When this day happened, the day after Brexit, and Monday, these days moved down and down. There is nothing for me to profile, so the profile here would not give me any information. However, when we came in on Tuesday and the market turned back on itself, now I have to draw a profile, because what I want to see now is what the combined days look like. So all of a sudden, if you watch the Trader Bite for Wednesday, you'll see that I drew this profile, because now I want to see what is the total mix of the volume on Friday, Monday, and Tuesday are, because those are the days that I'm going, that's the immediate auction I'm going to be trading in. Okay, and so I create a profile based on those days. Once Wednesday finishes, I include it in the mix, because I don't know if this morning we will go up and come back down and trade this gap zone, and again this profile. So from this profile, I can see where the volume is. I can see what the effect of each day is. For example, you can see here that the volume that was created on Monday is much, much stronger than the volume that was created last Friday in this particular high volume node. Like that. That's what this stuff is telling me. So if the length of the profile is the question is the length of the profile, that's how I determine it. The other determination is to take the swings. So I will start if I'm looking for a series that starts, for example, how do I know to start this composite profile on October 9, 2013? I very simply go back on a daily chart to 2000, and I look for the most recent swing, the most recent time that the market tested and then started to move away, right? So it did this, and that day is October 9th, 2013, and I start to profile everything that happened from that day, and that gives me this profile here, this composite profile. So I'm, it's a bit of an art to decide, but it's really you're answering a question. It's kind of like doing a statistical study. You're answering a very specific question, and that is, what information am I seeking? What information do I need to see? I'll give you a composite that was very useful today. It's right here. The market is moving and filling in the gap. I want to know where's the volume the last time we were here. We moved out of, once we moved into the gap zone, we moved above 2065. So the question becomes, above 2065, where is the volume? What am I trading against? What was the last, when we were here last time in this auction, what happened? And I can't take the last day that we were here. I can't take this specific day on its own. I take the composite, and then the composite tells me, okay, we're likely to push into this 2077 and get resistance initially. Now, if we go into what happened today, guess what? Here you go. It pushes, and then the first big down rotation happens at 2078. The composite point of control is at 2077.75, right? It pushed through by a tick, and we had this really nice rotation down of about 6 points or 5.5 points. That's the initial resistance. That's why I look for these levels, because I'm looking to trade them on the first touch. Okay, virgin levels.
And there's three other profiles that we do an overnight profile, we do a regular trading hour profile, and then we do inside the intra-pro profile. So those are the three other profiles that one may see on your charts.
Yes, the overnight profile just shows me what happened when the stocks are closed. The market trades differently and for different reasons. Once the equities, the underlying 500 stocks are closed, and this could be for any product. For example, Eurex trades from 8 a.m. London time till 4:30 p.m. London time, right? That's their RTH. If I was trading Eurex, I would create a profile just for that session. And then I would create a profile for everything that happens during the US session, because the equities are not trading. So it's behaving like a Globex session. It's trading after market, and that's what this profile is. So you'll see on the Trader Bytes that I go, and every day I'm looking at what happened and what it looks like, where's the volume during that session, and that's the overnight profile. And then there's an intra profile, which is something I just won't cover here. It tells me what happens inside of all of these rotations during the day. This helps me manage trades a little bit better. It helps me identify zippers. It helps me identify immediate short-term support or resistance while I'm managing a trade. Giving away the secret sauce here. Phil, how important is the footprint indicator in trading any futures contract? Not to poo-poo anybody's product, but it's irrelevant to me. I used the footprint indicator for a while. It can be represented in other ways. Here's the thing. This is like asking me, how important is the CCI indicator in trading futures? To me personally, I don't use it. It doesn't mean that it's not something that's going to be useful to you, but it's really a matter of taste. So if you like to see the representation of trading in the form of a footprint, and you can use that information and you can master it, and that's the key, you're not going to see a penny until you start mastering whatever it is you're doing. I'm going to say that again. You're probably not going to see a penny out of your trading effort consistently until you start to master what you're doing. You need to move into stage 3 of your development to start really reaping the rewards, and you can only reap the rewards once you've refined your process, not focused on the income and return profits. In other words, trading your P&L on your screen is useless for this endeavor. But the footprint indicator, I found that it was just way too much information. I mean, I can see in the dome that a whole bunch of stuff traded there, and it's just not that important to me. I found Bookmap to be a lot more useful for short-term tracking of who traded where and how much was there. The footprint only gives you one side of the equation, which is how much traded at any given price. What's the volume that traded at any given price? Bookmap tells you how much was there when it traded. So it's telling you what traded, and it's also telling you what was there, what was offered. I can see, if I decide to look here, I can see that 2,000 contracts were on the offer, and they got lifted through, and I can see by how much, and I can see it down to almost to the millisecond. I can see how much traded. This is how much volume came across. All these dots are executions. This is the stuff that the footprint would draw on a chart, but what it would not show you is how much was there, what was the bid, what was the offer. I find this a lot more useful. But overall, the reason I don't use the footprint, although it's a good tool, as good a tool as any, is that it was just giving me information that I couldn't use, and maybe you can use it, maybe you've mastered it, but it's not. It doesn't matter if you're using it in futures or equities. It's the same information. It's just not something that I find useful. Okay. Ron, I've heard you say that you don't put a lot of weight on cumulative delta because the market participants that created the delta may not be there later in the day. It's not accurate, but I'll correct that. Wouldn't that same theory hold true with volume in general as well? If so, it seems like less weight should be put on today's market profile versus a composite profile. Your thoughts? Okay, good. So I did not say that I don't put a lot of weight on cumulative delta because the market participants that created the delta may not be there later in the day. What I said is I don't like using delta, the relative delta, on that basis. I do use the delta here. This is the delta. This is the delta indicator, and what this is showing is how much was lifted on the offer, how many contracts traded to buy, minus the number of contracts traded to sell, and it tracks it on a bar basis. I can change this and make it view it in many different ways, and this is the information that the footprint is built on. And the way I'm using it is not to compare, okay, 48.63 traded on this high, but only 17.76 traded on this high. I don't use it that way because the participation at this high, after the European, right at the European close versus this high over lunch or whatever, not in this example, but it doesn't tell me as much information. What I like to see, however, is that price moved with delta. In other words, if price is moving up and delta is sideways or moving down, which we see often in the NASDAQ, it tells me something else. It tells me that as price was advertising higher, somebody was hitting the bid and pulling. There's a program that is executing sell orders on the way up. This is different information than, oh, it came up to this price, there were X number of buyers. Then it pulled back and went to the price again, and there were Y number of buyers, and it's less buyers, therefore there's delta divergence, therefore this is going to drop. I don't use it that way, and that's why I'm saying the participants are not always the same depending on the time of day. However, delta is important, and that's why it's on every chart. Here's my crude chart. You can see delta on there, and I'm monitoring what it does, and a lot of times I'll show cumulative delta on the zigzag. For each zigzag, how much cumulative delta is that was there, and I'd like to see that moves happen with delta behind them, especially impulsive moves. So if I'm trading this impulsive move right here from 71.25 to 78, for example, I'd like to see that there's a lot of delta on this move. It tells me that there is a higher time frame and it's meaningful, and it's not because price is not moving because sellers are pulling their offers and one lots are lifting the market, but it's telling me that sellers are there and 50 lots are lifting the market, and therefore it's causing delta to scream upwards. It tells me a different kind of information. Okay, so that answers that question. Trade management. I'm a scalper of the NQ, and all of a sudden my stops just don't seem large enough. Currently 15 ticks can give me any input. Can you give me any input on what you feel are reasonable? My goal is never less than 1-to-1. So Keith, you're trading a high volatility environment, and so a 15 tick stop in the NQ is dependent on time frame. You don't give me your time frame, so I have no clue how to answer that. But if you're talking about, when the VIX was, I'm only retaining 3 days of VIX. When the VIX is at 25, the number of ticks you use for your stop is not going to be the same as when the VIX is at 11. Okay, and so it's really a function of volatility. When the market's going through Brexit and is screaming around, then a 28 tick stop may not be good enough, but that's not an environment that is normal. And most of the time, what you have to do instead of being aggressive on those days is to back off. Now, if you have a $100,000 account and normally you trade 6 lots and you decide, let me cut it down to 2 lots and use a 40 tick stop, more power to you, because you're still risking the same amount, and the 40 ticks you're risking versus relative to your account size reduces your risk of ruin dramatically. And so you can sustain that type of trading. But if you're trading a $2,000 account with a 15 tick stop, and then all of a sudden the volatility such that the range and the rotations are 3 times as large, that now you need a 45 tick stop on a $2,000 account, you need to sit the market out. You shouldn't be trading a market with a $2,000 account, but we don't have the luxury of it. Not everyone has the luxury of that. So overall, you have to constantly compensate for what the market is doing. And it's really important for you to recognize that, hey, this is not my environment. I can't sit here with the same bracket orders, with the same number of ticks for a stop and a target in an environment where the market, where the NASDAQ is having, an average of 15-point rotations on moves. My 15 tick stop is, you're all of a sudden trading absolutely randomly. Whether the market is going to trigger your stop or target, if you track it traditionally, or in my testing on random coin flips, you're probably not going to do better than 30% win rate. And you're probably not going to get to the 1-to-1 ratio. So if volatility is such that 15 ticks is no good, then stop trading. Just don't trade. Either that or widen your stop and widen your targets. If the volatility is there, your targets should be compensated for as well with wider targets, okay? So that's the last of the newcomer questions. I'm still going to reserve these for next week's AMA for stage 5. And I'm going to go back to this question with Thomas. How or where do you find unusual activity in the options market, increased volume on calls or puts? I have 2 brothers make reference to increased volume on an option pretty regularly. If you're looking at trading options, there are several things you need to look at. And the volume or the open interest on any given call or option is important, and then the volume on those calls or puts is also very important. This is where I would look. If you're watching, like I like to trade weekly ES options when I do. And if I'm watching the same weekly options, the same 3 weeks out and so on, and all of a sudden I see that volume's 3 times the norm, yet the market's not really doing anything, it tells me that that strike that has all that volume, it's almost like I'll let you in on a little secret. It's almost like looking at people's stops. So if the market's trading at 2050 and all of a sudden there's a huge volume at the 2020 put, it's like seeing people's stops at 2020. It's essentially saying, it essentially could be saying that a lot of people are long with a synthetic stop at 2020, because that's when their put becomes in the money and that's what they're hedging. So they're hedging a position that's long and they have a stop at 2020, and that becomes a point of interest. So as the market starts to drop or turn away from the 20 to 50 price or whatever I said and starts to trend down, that I'm going to look for 2020 as a potential area where positions start to unwind for those people who are holding positions without the option. Anyway, that's probably beyond the scope of this conversation, but looking at open interest and trading volume on various strikes is a good way to determine where the money is going in and out. It doesn't mean that those are the strikes you should play, but you definitely do not want to be in a strike that is in an option or a strike that has no open interest. There's not going to be any market. You'll be trading against the market maker in that environment. So I'll wrap this up right here. I don't want to go over our time, and I think that's plenty to digest for now. Again, if you need to get a hold of me, you can get me right here. I'll let you go. It's 10 minutes before we intended to close, but I think this is enough for today. I hope you gained something from this, and if you have questions, hit me up. I'll do my best to answer. If not, then catch me on Twitter or the next AMA. Good luck, and I'll catch you tomorrow. Take care. And by the way, thanks, Richard, for helping me moderate.
You're welcome.